Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Cvs Health Corporation Annual Report. Cvs Health Corporation offers a wide range of businesses and services across three main segments: healthcare benefits, health services, and pharmacy and consumer wellness. The company's healthcare benefits segment provides various health insurance products and related services to numerous clients, including employer groups, individuals, college students, part-time workers, health plans, government units, labor groups, and expatriates. These services include medical, pharmacy, dental, and behavioral health plans, as well as Medicare Advantage and supplement plans. The health services segment offers pharmacy benefit management solutions, which involve plan design and administration, formulary management, retail pharmacy network management, specialty and mail order pharmacy, clinical, disease management, and medical spend management services. This segment serves a diverse range of clients, including employers, insurance companies, unions, government employee groups, health plans, prescription drug plans, Medicaid managed care plans, and CMS. The pharmacy and consumer wellness segment is the company's retail arm, selling prescription and over-the-counter drugs, consumer health and beauty products, and personal care products. This segment also distributes prescription drugs to various settings, including long-term care facilities, hospitals, and clinics. Additionally, it provides pharmacy consulting services and other ancillary services to these care settings. Overall, Cvs Health Corporation's diverse range of businesses and services makes it a leading provider of health solutions in the United States. Cvs Health Corp's stock price has seen a significant increase of over 24.31% in the past year, with its total return reaching 44.89%. The main driver behind this growth was the company's turnaround efforts under CEO David Joyner, who took over in October 2024. Investors became bullish on the company's prospects after his appointment. The Q2 2025 earnings report in July 2025 was a notable event that contributed to the rise in stock price. Cvs Health surpassed Wall Street expectations, reporting strong financial results and raising its full-year profit forecast. The company's solid financial performance throughout 2025, including record-breaking revenue of $402.1 billion, also boosted investor confidence. Analysts anticipate a natural shift in market share in favor of Cvs Health due to competitors like Walgreens and Rite Aid exiting parts of the market. While there was a slight dip in Q4 2025 earnings due to a goodwill impairment charge, executives reassured investors about the company's 2026 outlook, contributing to the overall positive performance over the last year. The combination of these factors has led to Cvs Health Corp's stock price increase, making it an attractive investment opportunity for many. Cvs Health Corporation market capitalization of $96 billion is significantly larger than the average industry peer of roughly $18 billion. This shows that Cvs Health Corporation holds a significant advantage in their industry. Cvs Health Corporation trades at a higher price-to-earnings ratio of 54 times and a lower price-to-book ratio of 1.28 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that investors are already valuing the industry with a forward premium for the industry, leaving limited opportunity to uncover undervalued stocks. The leverage on the balance sheet appears elevated, with liabilities of 70% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The company has consistently reduced its share count, reflecting a shareholder-friendly approach to capital allocation. The company have a dividend yield of 3.51%. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be attributed to a variety of factors across different industries and companies. In general, revenue growth is often driven by increased enrollment, adjustments for retroactivity, and changes in estimates of healthcare costs payable. Conversely, declines in revenue can result from closure of retail stores, restructuring plans, and competition from other healthcare providers. In the case of specific companies, Company A's revenue growth is driven by premium revenue growth, services revenue growth, and adjustments for retroactivity. On the other hand, Company C experiences a decline in revenue due to customer returns, unredeemed rewards, and loss on accountable care assets. Segments within companies also play a significant role in driving revenue growth or decline. For instance, the health services segment's primary drivers of revenue growth include retail copayments and capitated fees for medical services. In contrast, the pharmacy and consumer wellness segment experiences revenue growth due to intersegment revenues and net investment income. Government contracts and investment income also contribute significantly to revenue growth in certain companies. Company E's revenue growth is driven by contracts with CMS and revenues from the federal government, while Company F's revenue growth is attributed to net realized and unrealized capital gains, purchases of U.S. corporate securities, and sales of commercial mortgage-backed securities. Overall, the primary drivers of revenue growth or decline vary across companies and industries, highlighting the importance of understanding specific market trends and factors that influence a company's financial performance. Net income and profit margins. A shift in fortune, the net income and profit margins of a company underwent significant changes between 2024 and 2025. On one hand, there were decreases in net income, with a notable drop of $318 million from 2024 to 2025. This decline was attributed to the exit from certain programs, such as ACO REACH and MSSP. Additionally, the consolidated operating income margin decreased from 2.3% in 2024 to 0.9% in 2025. However, there were also increases in net income, with a notable jump of $950 million from -$1,185 million to $3,707 million. The consolidated net income increased to $2,136 million in 2025. Furthermore, the net income as a percentage of comprehensive income showed a significant decrease, from 96.6% in 2024 to 76.7% in 2025. The changes in profit margins can be attributed to various factors, including premium deficiency reserves and self-insurance liabilities that may have impacted profitability. The adjusted operating income, loss, margin also saw significant fluctuations across different segments, with a decrease of -143% for the healthcare segment and an increase of 139% for the pharmacy and consumer wellness segment. Overall, the net income and profit margins of the company experienced a mixed bag of changes between 2024 and 2025. While there were decreases in certain areas, there were also notable increases that suggest a shift in fortune. The company's financial performance indicates a consistent trend of generating positive operating cash flow. A review of the data from 2023 to 2025 reveals that the company has maintained a steady stream of cash inflows from its operations. In 2023, the company generated $13,426 million in operating cash flow, which is significantly higher than the subsequent years. Although there was a slight decline in 2024 to $9,107 million, the company still managed to generate positive cash flows. Furthermore, in 2025, the company's operating cash flow rebounded to $10,639 million. This trend suggests that the company has a strong ability to generate cash from its core operations, which is essential for sustaining business growth and investing in future opportunities. Overall, the data indicates that the company is indeed generating positive operating cash flow, demonstrating its financial stability and resilience. The company's debt levels have undergone significant changes over the past year. Initially, there was a modest increase in long-term debt from $59,702 to $63,709, 6.7% increase, as of December 31, 2024. However, this trend continued with an even more substantial increase of approximately $3.6 billion by the end of 2025. Furthermore, the company's long-term debt rose by $13,500 million from 2024 to 2025. In contrast to the rising debt levels, interest expenses have shown a mixed picture. While there were instances where interest expenses increased due to higher interest rates on new debt issuances, other periods saw a decrease in interest expenses. For example, interest expense decreased from -$2,000 $958 million in 2024 to minus $3,119 million in 2025. Additionally, the net change in interest paid was plus $82. The combined changes indicate that while the company's debt levels have increased significantly, interest expenses have not followed suit. In fact, there were instances where interest expenses decreased due to new notes with lower interest rates. This suggests that the company has been able to manage its debt effectively and mitigate the impact of rising interest rates on its financials. The financial performance of various segments and regions within the company has been mixed in recent years. On a positive note, the health services segment has shown significant growth, with adjusted operating income reaching $7,151 million and retail copayments revenue totaling $10.9 billion in 2025. The pharmacy and consumer wellness segment also performed well, with total revenues increasing by 11.9% and pharmacy segment revenues rising by 14.7%. In terms of regions, Medicare Advantage plans have been a standout performer, with over 81% of members enrolled in plans with 2026 star ratings of at least 4 stars. Pharmacy stores have also seen an increase in same-store sales and prescription volume. On the other hand, some segments and regions have struggled. The corporate/other segment has reported an adjusted operating loss of $1,348 million, while the healthcare benefits segment performed relatively poorly in 2023. The frozen foods segment saw a decline in revenues, and the store operations segment did not report any notable growth. Additionally, trade receivables decreased by $982 million from 2024 to 2025, while vendor and manufacturer receivables increased by $1,673 million, and premium receivables rose by $1,022 million. Overall, these mixed results highlight the need for continued focus on improving performance in underperforming areas. CVS Health's company outlook and strategy. The company's management is optimistic about its future prospects, driven by significant growth in its government business. This growth is largely attributed to the Inflation Reduction Act, which has contributed to a substantial increase in revenue. To build on this momentum, CVS Health is investing heavily in its colleagues and capabilities to drive business performance and improve underlying trends. The company's focus on digital transformation initiatives is also expected to enhance customer experience and drive growth. Strategic acquisitions, such as the Aetna acquisition, have expanded CVS Health's offerings and improved its competitive position. Despite facing pharmacy reimbursement pressure, which has impacted operating results, management remains committed to managing this risk through various strategies. Financial performance has been strong, with revenue growth across all segments, including a 9.7% increase in total revenues in 2025. Adjusted operating income also increased by $2.6 billion in 2025, driven by improved underlying performance and higher favorable prior year development. Overall, CVS Health's company outlook and strategy are centered on driving growth, investing in its people and capabilities, and managing risks to achieve long-term success. The company has made several strategic moves through acquisitions and divestitures. In terms of acquisitions, the company has purchased Signify Health, Inc., and Oak Street Health, Inc., both of which are significant investments aimed at expanding its services. On the other hand, the company has also undergone a series of divestitures. One notable example is the deconsolidation of Omnicare, LLC, a wholly owned indirect subsidiary, on September 22, 2025. Additionally, the company has closed down 271 retail stores in 2025 and recorded a store impairment charge of $607 million. Furthermore, the company has also divested itself from Linens 'n Things, a former subsidiary, as well as other former subsidiaries with retained guarantees on store lease obligations. These moves are likely aimed at streamlining operations and reducing financial liabilities. The company has a history of rewarding its shareholders through various means. One way it has done this is by paying dividends on a quarterly basis since becoming a public company. This demonstrates the company's commitment to sharing its profits with its investors. In addition to paying dividends, the company has also been actively buying back shares from the market. In 2024 alone, it purchased 39.7 million shares for $3 billion. This move not only reduces the number of outstanding shares, but also boosts the earnings per share, EPS, for existing shareholders, thereby increasing their wealth. Supply chain disruptions. a growing concern. The threat of supply chain disruptions looms large over businesses, with potential consequences that can be far-reaching. According to various sections of a report, supply chain disruptions can have a significant impact on operating results, cash flows, and financial condition, page 35. This is not an isolated concern, as reimbursement pressure caused by competition has already affected retail pharmacy operations, page 37. The emergence of new distribution channels may further exacerbate the issue, making it more challenging for companies to directly engage with consumers and other customers. If businesses fail to collaborate effectively, this could lead to supply chain disruptions that hinder operating results, page 53. Moreover, changes in the economic environment can create exposure for increased costs and supply chain disruptions, page 67. While there is no specific mention of these concerns in the commentary section, page 77, it is clear that supply chain disruptions are a pressing issue that companies must address to mitigate potential risks. That concludes the financial summary for CVS Health Corporation. Feel free to comment below, and I will be happy to answer them when possible.